to bring up the specter of 98, 99, 2000. Not that we're exactly in the same place. There's a lot of differences. In some ways it's better, and sometimes in some ways it's worse in that period. But the trade then for years, going into the top of the bubble, and almost every other major bubble is the same way, is not to try and short the market. It's to try and buy cheap volatility above the market to capture a widening specter, a megaphone, if you will, that happens before markets ultimately become unpinned in some type of bigger top. So it's a much better risk reward trade.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was on this program back in September, he predicted the market would start to become more volatile. He didn't necessarily think that would mean lower stock prices into the end of 2024, and he was proven correct on that. But he did express worry that as we entered 2025, continued higher volatility could start to become a real problem for investors. Does he still think that? Well, to find out, we welcome back to the program Jim Karsan, founder, CIO, and managing principal at Kai Volatility Advisors. He's widely known as Jam Croissant on X. Jim, thanks so much for joining us today.
Wonderful being here. Thanks for having me, Adam.
Such a pleasure. Happy New Year. Really looking forward to getting your thoughts here at the start of the new year as to where you think things are headed. Obviously, I want to get into your volatility outlook real quickly before we do, just to set the stage. Let me ask you this question I like to kick all these interviews off with. What's your current assessment of the global economy and financial markets?
Well, I think we're really heading to a place where ultimately the market itself is expensive. There are a lot of headwinds facing the market at a time when it's expensive. So, from a weighing machine, kind of medium to longer term view, this is a market that is not in a very good spot, particularly after two 25% type years, 50% return, after an election year, which are very positive, particularly in these populist periods. What comes next is not great. So there's a lot of reasons to be cautious. That said, we also have the introduction of a big wild card and a new disruptive president and cohort of people who are surrounding him, including Elon Musk, that are intent to do things differently and are also focused on financial markets in many ways and liquidity, and running kind of a hot kind of monetary machine. So it is a combustible situation, for lack of a better term, hence the call for higher volatility late last year. And again, that doesn't necessarily mean in the next year or 6 months that we get a decline. It could very much be higher prices. But higher prices at this point would not be a healthy thing, in my view, and could very well just be a sign of a kind of final topping process. And that can often last a year or 2 years. But again, our current view is that there's really two paths, and we can dive into this a bit more as we talk, but there's really a path where if the liquidity doesn't come really in relatively short order in the next 3 months and a meaningful way, that a lower market will create poor liquidity in a very broadly negative situation and be very hard for the Federal Reserve and the Treasury and the administration to fix. But if they can juice the market, push it higher, again, given Elon Musk and his history with Tesla and their knowledge of markets broadly, if they take that approach, this market will go quite a bit higher, and there's quite a bit of fuel to that in the short term. But again, that would ultimately, to me, feel something like 99, 2000, and really look more like a blow off top. So long-winded answer to a short question, and I'm sure we'll dive more into all those details. But it is a combustible situation and a time to be really focused on really inexpensive, long-dated implied volatility and gamma, and you can bet on the market volatility that will eventually come through parts of the distribution, not necessarily just long or short the market. And I think there are real opportunities there.
All right. I'm going to really look forward to digging into that with you. You used the term inexpensive not that long ago, maybe like a month or so ago. I remember it being talked about that like, puts on the S&P were like the cheapest they'd been in a long, long time. Are we in an environment right now where um, some of these bets on volatility are pretty cheap?
Yeah, I want to be clear. So implied volatility, I called for this last summer. I called for it in October, November, December. There are periods when implied volatility is really cheap, like in terms of just a nominal number, but given the structural flows of the market and given the vol supply that's out there, it involves a sale at those low levels. And that's more often than not the case. This is not one of those cases. And I think that's the important part. When I say cheap, it's cheap relative, you're talking about implied volatility relative to potential realized volatility.
Yeah.
And it's easy to look at a number and say, well, the implied volatility is low relative to history. That's the easy part, right?
Yeah.
But there is a reflexive piece to that engine, which is if there's really a lot of structural flows that are supportive and the vol is compressed, then it's a circular reality where that implied volatility compresses realized and vice versa. So you get into these periods of a lot of vol compression and very little move. That is not always the case, though. Sometimes you're coming out of those periods of vol compression and vol is very compressed still. And for other reasons, because of the introduction of maybe liquidity like we're seeing now at a push, you can be setting up for a real meaningful increase in vol. And that's a real opportunity. And so cheap is all relative. Value is what is value, right? I'm here to tell you that the implied volatility that is historically very low also has a lot of reasons why the structural support is not likely to be as strong here in the coming months and the year broadly going forward. And there's a lot of impetuses to also unleash that catalyst to release that vol as well. And not just one, but I could think of 7 or 8 or 9, given the introduction of the new administration and all the disruption that's going on globally.
Okay. Can I repeat that in much more basic terms to see if I got it right? Where there are times where, like a coiled spring, um, uh, potential volatility, like the potential energy is high in volatility. It hasn't moved yet, but it's got a lot of potential energy just kind of stored up there. And I hear you saying, if I'm getting it right, we're kind of in a moment like that, where the spring is pretty tightly coiled. There's a lot of potential energy there. And you're looking across this year saying, I can think of not just one, but a number of different triggers that could cause that spring to violently uncoil. Am I capturing that?
Yeah, I think you captured probably the most important part. I will say there's an additional part that I probably didn't express, so I wouldn't have expected you to summarize this. But there are important dynamics structurally as well. That if the market continues, part of the reason vol is low in this environment is not just that it's been compressed and been sold throughout October, November, December because of structural reasons beginning of the year. But also because we've slid so violently, so quickly up in the market in the recent month. And that has really led us to naturally, based on market structure, lead us to an even lower implied volatility. Mm-hmm. And so there is a unnatural structural set of effects, I would say, that have led us to this really low volatility, and that if we have set us up to even lower volatility if we continue to go higher. And those realities have made it such that the vol is too low, and to your point, then there's a lot of reasons for it to continue from here.
Okay. I want to ask you some questions about liquidity, but again, just to kind of capture the spirit of what you're saying, as a investor who invests in volatility, tracks it very closely. Are you looking at 2025 as a year of potential high opportunity for your type of approach?
Absolutely. Yeah,
Okay.
I think it'll be a couple of years of it, honestly, not just the coming 6
Okay.
months or year.
And just to be clear for viewers, opportunity for you may not be what the average buy and hold investor would see as opportunity, right? Like a very volatile year for you could be great because there's lots of volatility. If that reflects in very volatile prices, maybe a lot of price downward action, that could not be a welcome year for the average, just kind of buy and hold, put my head down investor, right?
Um, it could be, and it could not be, right? And what I
Yeah.
mean by that is, just because I'm saying that we're going to have a more volatile outcome doesn't mean markets will be lower this year. It means that markets will be more volatile. And so I guess you could say that it's going to introduce risk, and in terms of standard deviation and move for a buy and hold investor. In that sense, it's bad. But they could have, 99 was a very good year for buy and hold, right? It didn't end well in 2000, in 2001, right? But it was, the biggest gains often come at the end, in terms of speed and move. But they can also be, like I said, incredibly volatile. So again, to bring up the specter of 98, 99, 2000, not that we're exactly in the same place. There's a lot of differences. In some ways it's better, and sometimes in some ways it's worse in that period. But the trade then for years, going into the top of the bubble, and almost every other major bubble is the same way, is not to try and short the market. It's to try and buy cheap volatility above the market to capture a widening specter, a megaphone, if you will, that happens before markets ultimately become unpinned in some type of bigger top. So it's a much better risk reward trade. So I don't want to say because we're having more volatility that is bad for long. This is not a short bet per se.
Great. So I'm glad you specified that. What I was trying to say is a good year for you doesn't necessarily mean an up market for the indices, which I think you would agree. You're nodding, right? But you're also saying a good year for you because of higher volatility doesn't mean a bad year either. It could go either way, right?
Correct.
But I think your bigger point there, I just want to underscore for folks, which is as we tend to approach the end of what do you want to call it? A blow off top in a market, or just a richly overvalued bull trend that eventually reverts. As you're late in that bull cycle where volatility can get really big, even though the trend is still up, you're saying if you're worried about this cycle ending, rather than short and perhaps get short too soon and get killed by this volatility as things still move up over time, much better to bet on the volatility itself, correct?
Absolutely. Not even close. Yeah.
All right. Awesome. All right. Well, we're going to dig more into that. Real quick, though, I just want to define liquidity. There's a lot of different definitions of liquidity. So I'm curious, what are the major inputs that you look at when you're talking about liquidity? Especially because, there's a lot of things that are kind of in flux right now with the new administration coming in. In fact, right as I was waiting for you to come on, Jem, I saw a headline, true or not, take this with a grain of salt, but I think that Trump basically just said, I'm going to freeze the funds being deployed by the Inflation Reduction Act. There's lots of different steps the administration is taking right now that is impacting the flow, we'll say, at least of funds in the system. So when you talk about liquidity, what are the things that you're watching most?
Yeah, I mean, there are different kinds of liquidity, right? I kind of break them into two broad buckets. And the truth is, or you can't break them into two. There's a kind of a gray. This is not black and whites, but there are two kind of poles in my mind of liquidity. There's more fiscal liquidity, and then there's monetary liquidity. They both act on the cyclical kind of flows, liquidity in markets in varying ways, but they both have a similar impact in the short term in terms of rushing money into a system. To varying degrees, they have different velocity to their impact in the short term. But over the medium to long term, they have almost opposite effects. So it's important to delineate. People hear, oh, there's been a stimulus, and they think they're all the same thing. Monetary and fiscal being very different kind of forms of liquidity. Monetary liquidity, otherwise, central bank liquidity, treasury liquidity, are supply side economics. They're essentially sending money to producers in the economy. It's corporations, wealthy individuals, investors. That has almost zero velocity to it after, let's say, an initial kind of push and some money kind of trickling down early on. That ultimately is a deflationary force in the medium, but definitely over the long term. So you send more money that way and you get a short-term boost, but then all of a sudden it's a deflationary structure because the cost of goods go down. It creates more competition, creates globalization. All the money is being sent to a set of actors who are essentially have a profit-seeking mechanism. Their full goal when they take on that money is to make more money. And that ultimately drives, again, compression of costs, which are compression of labor costs, particularly domestically, or where the demand is. The other form is fiscal policy, and that is almost a velocity of one. This is the form of liquidity that economists largely thought about when they thought about money supply and how inflation and in a very simple kind of mechanism, right? And that really the reason that monetary policy doesn't really work the way that a lot of economists thought early on is because it's not a closed system. Right? If it was a closed system, it would, but there are ways to kind of bend. A corporation can bend the velocity by not hiring more labor. It's not a closed system, to go outside the system to cheaper labor. They can create new technologies and innovations, which then, with that money, that can then again drive deflation, not inflation. So it's two very different types of liquidity. Again, a simple question, complicated answer. You're going to get a lot of those here, but the point here is when I talk about liquidity, I'm talking about all of them, but you have to look at them in a very because I'm talking about the short-term effects. But again, it's important to denote when we're talking about that liquidity that where that liquidity comes from is incredibly important, and thinking about them will help drive very different outcomes past the first 3 months or so of their introduction. It will over 6 months, 9 months, a year, 2 years, 4 years. The different forms of liquidity will actually drive almost opposite outcomes for financial assets. But in the short term, we look at all those central bank liquidity, treasury liquidity, business GDP output, and financial market movement itself is a huge, maybe even the biggest driver of liquidity, which is again reflexive, but incredibly important. But these are the primary levers of liquidity.
Okay, so you said earlier, you think if liquidity continues to rise from here, then markets should do pretty well. But if I heard you right, you sort of expressed a short-term concern that liquidity could be facing some headwinds. I don't know if that's a great analogy, liquidity facing headwinds, but it could start draining or whatever, right? So if I got your concerns right, what are the things that maybe a better question is just, what are the biggest factors you're looking at right now that you expect to impact liquidity, and how do you expect them to impact that liquidity?
Yeah, I think last year was an election year, massive fiscal and monetary kind of support throughout the year, primarily from the Treasury. That was a big source of it. We also had a massive increase of equity prices, right, for 2 years. So to put that in context, I really think this is an important point that very few people understand, and because there's a lot of linear thinking. Generally, people think, well, cause effect. That is like a very linear thought. But again, a lot of these things are reflexive, so there is a non-linear component. But when you have markets, that are about, U.S. and international markets, which are very much connected, are about $100 trillion, give or take, right? And never mind all the private equity and private credit and all the things that are connected to that.
Yeah.
That really is 200 million plus. But let's say before the market rallied 50% in the last 2 years, let's say it was 100 million. Now it's 150 million, right? Not million, trillion. Missed a couple of zeros there. 150 trillion. And so $50 trillion of new collateral has been created in the world. I don't know why people don't talk about this more. Like that, like it's almost like we will look at markets and we think they're like some just number, like it has nothing to do with the system itself. And we believe the Fed when they say, well, our primary function is to manage liquidity, but we don't manage markets. We don't watch markets. Yet we've created $50 trillion of new collateral in this world in the last 2 years. And then we worry about the 2 or 5 or $8 trillion of monetary or fiscal spending and how that affects markets. The truth of the market is it's a circular mechanism. When the market goes up, you have more liquidity and you get more GDP output because there's just more money chasing everything. And then when the market goes down, the opposite happens. And people talk about the market like it's a third party in the system. It's just a report that comes out from the GDP. Like the economy runs, and then there's this thing, the market, that just shows you how the economy is doing. They're so integrally connected. And to be clear, I would argue markets are actually more important than the economy in driving economic output. And so when people say, oh, the market is forward-looking, the market's not forward-looking. I mean, sure, a little bit people are putting their speculation in of what the market is. The market defines the outcome. The reason the market's so efficient is because whatever the market does is what happens to the economy. If we get a dramatic decline in the market, guess what? We're going to have a recession. That's how it works. And I think so few people truly get that's really the way these things work. I mean, sure, it's a push-pull. There's two sides to this story. But the market, given the size of the market, particularly given the amount of leverage, the majority of money, what we call money, is not money. It's leverage. It's loans.
Right.
And in a leverage system, which everything is levered. Like the second a bank gets money from the Fed, they're levering that money. That's where money comes from. The second that if we make 10% and our collateral goes up by 10%, well, guess what? To make the same amount of money or to keep the same amount of economic activity and goals for risk, we now have to dramatically increase the investment, which drives more of the same. And then vice versa. And that's why when you get in a deflationary loop or a decline in the market, you get into this really a liquidity issue of a circular decline in GDP and then in markets and whatnot. So I think that's the most important point, right? About that market outcomes themselves define the outcome itself and of the economy, and then and so there's a momentum factor here. And so when I sit here and say early this year, if the Fed and the administration don't pump more liquidity in a meaningful way, given that the market's up 50% and there's some kind of flagging signs that things are going to slow down, and there tends to be give back after long runs, and the positioning in the market is weak and shows potential. I'm really speaking a lot of that, not all of it, to risks in markets, and that that ultimately, if they don't stimulate now and get momentum going and create more liquidity, they get so much leverage on the liquidity and the timing. And that's something that the Federal Reserve, I think, is starting to really understand. That it doesn't, that if they do some, like if they did $5 trillion of stimulus, like increase liquidity by $5 trillion now, they would get probably $20 trillion of output out of that. But if they wait for the market to really decline and to have kind of a weak spot here this year, given a lot of other things that are going on in the world, and other natural liquidity drain, which I can get into in a second, then they're going to have a really hard time battling a 20 trillion, $30 trillion outflow from the market, and won't be able. It'll be too hard to reverse that. So it's a matter of timing on their end, and it makes a huge difference into the outcome. Anyway, that's an important part. Now, there's other pieces, which I'm sure you're like, well, but if we don't know where the market's going to start, right? Like then why does it have to go down, right? Is the next question. And that really is some incremental liquidity. That's a function of both higher interest rates and a lag. I think there are structural forces that are driving inflation. That's structural. It's been clear at this point. We've been talking about it for a while, and I don't know how much more we could say about that. And again, we've gone through transitory inflation 4.0 at this point. But the reality is that is not just a function of price; it's a function of time. And we're now 4 years removed from the bottom in interest rates, and the 10-year, which at the time we called for to go to 5 in a matter of years, is now here. And it's here right as, not surprisingly, it's not a coincidence, right as people are about to, in the next year or so, really have to increase dramatically the rebalancing of leverage, and have to reaccess markets. And that's not just true for individuals. It's and real estate, which is what people first think about, but more importantly for venture capital, for private
corporate
equity,
America, there's a massive debt refinancing.
Corporate, yeah. And this is all coming to market in the next year. So, or beginning to come to market, I guess I should say. And it's not going to slow down from here, to be clear. So unless you can, lower interest rates and dramatically increase liquidity early and get ahead of this, it will begin a really poor loop. And I really think that starts in Q3, but people don't wait till Q3 to start betting on those outcomes and forcing outcomes. So again, there's two paths here, and neither of them is lacks volatility. This is increasingly what I call a sumo market. I've kind of tried to if the market doesn't move, doesn't mean there's no risk. You could have too skinny, almost no pressure, and the market wouldn't move. Like little going on, no wind in the air, and so the things don't move. But you could also have two sumos pushing against each other with immense potential energy, and the thing couldn't move.
Right. I live out in California, not unlike an earthquake fault line. Right?
Another great analogy, and I think I think you may have brought that up before, and that's like such a great metaphor. I completely agree. So it's like a fault line, right? So yeah, things may not feel dangerous, but the potential energy building as we go forward in time, as that overhang and liquidity starts to come out after 2 years of increased liquidity and kind of gravity battling against that. Also, valuations are the gravity essentially. We're in a more dangerous spot, and any a misstep or not pushing back enough against as things start to move will create a big colossal move, and it'll be too hard to imbalance that, to rebalance that when things.
So let me ask you about our sumo wrestlers here. It sounds like one of them Um, let's say if conditions were unchanged, um, one can make an argument that the contracting liquidity sumo wrestler would win out, right? Because the more time we have going on from here throughout the year, we go into that debt, we go further into the debt refinancing. Um, a lot of the liquidity that's been put in by the authorities, um, like draining the reverse repo program, right? Things like that. Like that's beginning to get near its terminus, right? There's stuff like that, right? We got a new sheriff in town in the administration who is at least talking a game of uh, more prudent fiscal spending, trying to get the deficits under control, stuff like that, right? So if those status quo trends were to continue, you would assume that the upward pressure on liquidity would diminish over time. So what I hear you saying is if the administration wants to avoid that wrestler winning out, it's got to start helping out the other
Aggressively,
guy, right?
aggressively.
Yeah.
Yes.
So I know that Trump just, yesterday was saying, "Hey, I think the Fed should bring interest rates down." So he's gonna be pressuring Powell. Now, is the Fed truly independent or not? I don't know. We'll find out. People definitely have their opinions. But let's say that liquidity starts getting added in materially by the Fed, maybe even still by the fiscal side of things. What about the inflation limiter, right? That's been one of the things that's been sort of handicapping the Fed of late, right? The Fed wants to bring interest rates down, but sticky inflation is keeping it from doing so. So you raised your eyebrows when I mentioned this, but I mean, can can we support the pro-liquidity sumo wrestler, or could inflation actually thwart our ability to do that?
The R is the rub, right?
Yeah.
Like yeah, they can manage liquidity over some period. They can manage markets over some period, and they will try to. I'm confident of that. The incentive, at the end of the day, people respond to incentives, and those incentives are generally short term, and so they will not. They will deal with a longer term problem later. Um, but the great irony is, by focusing on the short term and trying to manage this in the short term, they will create a bigger long term problem. This market is not immune to gravity. The weighing machine will,
Will win out in the long
will
run.
win out in the long run. You cannot, I've had the people ask me, well, wouldn't they just, if interest rates just started going higher, given debt and everything else, and wouldn't the Fed just come in and do, twist? Like, wouldn't they just sell longer dated, and bonds and buy shorter term and just keep interest rates lower? Like, they can do that. And the answer is sure, they'll probably try that too. But the problem with that is if you keep interest rates too low relative to inflation, what happens? You increase inflation.
Right.
It's a circular problem. You cannot keep pushing liquidity to manage an inflationary problem, a slowdown, and then in the face of an inflationary problem and avoid inflation. You will exacerbate it. So as of there are some ways out. I don't want to make it sound like there is no way out, but it's very difficult, and it's a matter of big structural changes in the face of massive pressures to have to avoid the decline in assets and the rebalancing of kind of valuations relative to what's structurally happening in the world.
Okay. So what I'm kind of taking from this conversation, Jim, is you're saying, look, the piper's going to have to be paid here. And it's either going to get uh, paid in the nearer term, if they don't add a bunch of liquidity right now, and volatility is going to increase, but we're going to see price corrections more likely to the downside than the upside if liquidity is draining. Or they're going to come in, they're going to put more liquidity into the system here, And yeah, things might still get more volatile, but the trend will be up until the point they have kicked the can down the road as far as they could, and the piper will need to be paid. His bill's just going to be even more expensive at that point in time. And so I'm trying to sort of look at this through investors' eyes. So what I would take from what you're saying is expect volatility to get higher from here. Be aware that we could see, uh, a material downward correction in the market this year. But if we don't, because they start flooding the system with liquidity, expect more swings going forward, but expect at some point in time, it might be 2, 3 years from now, there's going to be an even bigger downside correction. And so
Yes.
okay,
I think that's I'll leave it there. That I think that's a good assessment. I mean,
okay, good.
Markets, if we continue to go higher, the inflationary pressures, which are structural, will be exacerbated if they try and reduce interest rates, flood liquidity. It's going to get worse, and eventually that will be the thing that takes the markets down. Yeah, I think the Fed is in a very tough spot now because they no longer have the ability, as they have for 40 years, to battle against a structurally deflationary environment and essentially provide more and more monetary stimulus at greater and greater amounts to counteract that deflation. Now they are
I mean, that was
battling an
2009,
inflationary.
2009 through 2021, right? I mean, the Fed could almost act with impunity. And
honestly, it was even before that, but it took till 96 for Greenspan to decide, oh, wait, we can do more. But really the roots of this go back to 1982.
Okay. I could pull on debt and I could pull on the Fed balance sheet and all that stuff, but that's a little too wonky for now. All right, so let's get to the so what now, Jim. Okay, so I'm a regular investor. I've just sort of heard Jim's outlook here. So if folks want to listen to your counsel and say, okay, maybe the thing to do right now, if I'm kind of nervous about the vulnerability of markets going forward from here, rather than doing something extreme like shorting the market and then having this thing go up for another 2 or 3 years and getting destroyed. All right, maybe I don't want to do that. Maybe I don't necessarily want to just sit in cash, especially if the market could go up for another couple of years and I'm just sort of missing out on the game. Sounds like you're saying the risk reward play right now for those that are concerned about what we've talked about here is to play the volatility side of things. So talk to us about how folks could consider doing that.
Yeah, Adam, I want to reframe the thought process.
Please.
The whole world, because of the way financial markets started with just a buyer and a seller valuing an asset in a very two-dimensional way. Prices went up or they went down. The whole world thinks that all information is all bets that one can make are somehow linear. Things go up or they go down. And even when we talk about vol, I feel like, oh, well, the vol's the path, right? That's another up down, like long vol, short vol.
Yeah.
That's not what I'm really saying. What I think there needs to be a reframing, and I think this is happening in financial markets for those that are in financial markets, really more sophisticated. They see this, but we're in a world where fortunately you have the ability to now increasingly bet, not in up and down, but in three dimensions, right? We've gone from a flat world to a three-dimensional world. And it's always been a three-dimensional world. We were just taking pictures and drawing doodles. The market has evolved to allow for the expression of all information in a much more precise way. No investor at this point should be betting on up or down. If you're betting on up or down, you're living in in a cave somewhere in the dark ages. The reality is, when you make a decision about anything, you have some information, it is nuanced. It is very specific to a bet that is not just up or down. Do you want to be long a stock? Well, maybe you like parts of a stock, or you think that it has a high probability of really a big potential payout if they get some drug right approved, or come up with some innovation. But that doesn't mean you like everything about that stock. There's probably risks to that stock that you don't like, or outcomes that over time and distance that are not good bets. Every asset is a complex three-dimensional thing, and whether it's a stock or a bond or commodity, and every piece of information is nuanced. So we should be betting on the information we have, the edge we believe we have. And if you want to get the best risk-adjusted reward in any scenario, you should be trying to align the bet that you have based on the view that you have in the most specific possible way. And you can do that. Like, it's easy to do that now. Why would you just be long or short of the asset in response to the information that you have? So I think that's the way people need to reframe and think about bets, probabilistic outcomes. You and I, when I make a decision, we don't just say yes or no. We think about, there's this piece and there's this piece, and we're probabilistically trying to come up to the best. We may not think, not everybody may do the math in their head, right? But they're thinking about the nuances. So there needs to be a more that kind of thought process. So when I'm saying be long, volatility, you need to go look at the distribution of outcomes and see what part of that distribution is way too cheap, and own those parts. And maybe that might be long, one part betting on an up move, and maybe one part betting on a down move. And they're both very specific bets at the same time, but you may not be long or short. You may be betting on certain paths of outcomes which are way more likely, right, relative to their pricing, while ruling out all the other parts that you think are relatively fairly valued, or maybe selling one that's expensive that's on the downside and buying one that's cheap on the downside. So
got it.
I think we need to be much more nuanced in how we bet. And by the way, people are like, why in 2021 people are like, this options boom is, it's a short-term, people are betting money and they're betting like crazy and this will fade. And I was there in 21 telling people, no, this is much like work from home. This is not going away. This is the acceleration of a trend that's been there since the beginning of options that will, continue to take hold. They are superior technology, a superior way to bet on outcomes. They're more specific. And at the end of the day, guess what? There's a reason the options market is eating underlying markets, because underlying markets are just an expected value of a much richer distribution of outcomes. They are simply, when we talk about the tail wagging the dog, they are the tail. They move based on how the different parts of the distribution and the market move. They're simply an average of every single infinite outcomes that can happen in the market. And if you peel away the options train, you'll see what those paths and outcomes actually are. And so that's what we should be, that's how we should be positioning. Not on up or down.
All right, that's super helpful and super fascinating. And your description here sort of reminded me of the book Flatland by Edwin Abbey. Absolutely. Are you familiar with that book?
Totally.
Yeah, totally. Yeah, and so it kind of makes your brain hurt because you have to think two-dimensionally and then three-dimensionally, and then what the third dimension must look like to a two-dimensional creature and all that stuff, right? So you're encouraging us to think three-dimensionally. And I think I get what you're saying here, and I'm going to make an analogy that's probably imperfect, but it's like you could bet on a sports team; it's going to win or lose, right? And whether it does or it doesn't, whatever the outcome is the average of all the players and all the plays that were made on the field, right? But you might, if you had the ability to say, look, I want to bet that this hitter is going to get on base against this pitcher in this inning of the game, and I can look at his history and say he's got a really high probability of doing that, that might be a much better bet for me to make than just betting on the average of the outcome of the game, right? I might have much better odds of being right, right? So you're saying the financial markets have been evolving to the point where we can make much more of those type of bets, right? So while, you know, that hitter might do great in certain scenarios and this other hitter might do terrible, and I might actually want to take bets against that guy in those situations, I can do that, and then I don't have to worry about letting the averages hopefully come out, you know, according to a probability scale that I don't have a ton of control over. Am I kind of capturing the spirit of what you're saying, right?
I think it's very well put. Yeah, I think that's a great metaphor.
Okay, good, good. All right, so you've now, you know, challenged investors to think this way. You're also making my point for me, I don't think intentionally, but you know, Jim, I say a lot of people, you know, they should watch this channel to make themselves more informed as an investor. But you got to really be really honest with yourself about what your strengths are and what they aren't. And you know, in a lot of areas, um, you know, you shouldn't feel bad about calling for professional help, right? And if thinking three-dimensionally like this doesn't come naturally to you, then find, you know, a professional advisor who can help you think this way rather than just groping around in the dark yourself. Okay, so to you, if somebody is thinking about, okay, I think I get what Jem is saying here. What are ways that you would think about them, you know, adding vol exposure to their portfolio? Yeah, I mean, I guess, are there certain approaches that you would encourage people to look at or think about, given the overall framework you just provided?
Yeah, I don't think we have to think about it like as being long or short volatility either, right? That's kind of part of the point. I think we need to get the optionality.
Mm-hmm.
People just equate options as vol. Options are, each option is a spot on a node of the distribution.
Mm-hmm.
And I think we need to make more precise bets on what's happening. So my advice, you know, very specifically, if you want just actionable, is I think calls, anything further than 2 months, 3 months out in this market, in equity land particularly, but across the board, given that this is a liquidity issue, are way too inexpensive for structural reasons. The right tail, right? Given that we're in a structurally inflationary environment, that we're talking about increasing liquidity in the face of a structurally inflationary environment, and given that risks are expanding after a 2-year 50% run in markets post an election, for all the reasons listed, that right tail should be worth a lot more than what the average vol is historically. And it is dramatically lower right now than the historical average. Those two things don't make sense together. The reason it's happened are structural effects. And again, simply because of skewness in the market and the fact that everybody is long the market. So they hedge to the downside and they sell calls to the upside. And there's structural flows that create these dynamics. And particularly after a big run in markets, those calls become very cheap. Pair that with, you know, structured product issuance, which is higher than ever because people are trying to go in a more non-correlated way because markets, they see what's happening in markets and they'd rather find, you know, other ways to kind of place their bets than just long or short, like I've talked about.
Mm-hmm.
But given all of these effects, we're getting a very, very structurally cheap upside call vol, which is not in line with the distribution of potential outcomes. And so if you want something that's like the market's giving you an edge, and it's, you know, it's that. It's right now. Now there's a lot of things, other edges. There's a lot of other things we can do around that trade. There's a lot of other ways to create, to fund that. That's good, and we can get to better outcomes than even that. But at this point, when you can get a 10% implied volatility, and long-term implied volatility for markets is closer to 17, and we're looking at kind of the world as it is right now,
Mm-hmm.
you would be, in my opinion, insane, I can't think of a better word, to be long stock two-dimensionally instead of long calls, instead of long that part of the distribution, which is being given to you for a credit. Why would you want to be short puts effectively in this market? If you want to be long, just be long the call and be long the out of the money call, the most convex part, which given market structure is more likely to play out as well.
Okay. Wow, fascinating. And again, folks watching, none of this is personal financial advice, but I very much appreciate you being so transparent and specific, and yet general at the same time of trying to come up with an observation that you're seeing about in the markets right now. And obviously, at your firm, Volatility, you are trading based off of that observation, but you're probably not making a simplistic trade. You are probably making those very specific ones that you were referring to earlier, correct?
Yeah, we do different things in different products, to be clear, but absolutely that is a structural observation that is an important source of edge across different strategies.
Okay. All right. Well, look, let me pick up a thread from something that we talked about earlier in your previous appearance, and then we'll start wrapping things up here. We talked a little bit about AI last time, and even just sort of some of the concerns of the return of all the capital spending that was being done in AI. There's a number of folks that have raised the concerns that, hey, hundreds of billions are going into this, and we're not necessarily seeing yet the incremental profits or revenues that we were hoping to yet. Now, I think jury's still out on that, and the AI train has been running at full steam since. So certainly on the margin, the market has not cared about this yet, and we just a couple days ago, the new administration just announced this Stargate project that's going to put like 500 billion into AI or something like that. So it's clearly, being tightly embraced by the country, as in many other countries, as a strategic national priority to win in AI, right? That being said, we have a situation right now where never before has as great a share of global capital been in the U.S. equity market. Never before has the U.S. equity market cap been concentrated into so few stocks. Essentially the Magnificent Seven, call them the Mag 10, if you will. And the stock that is punching the most above its weight by far in that category is NVIDIA. But it's basically AI is the theme of those small number of stocks, right? So I guess my question is for somebody like you that looks at risk a lot, do you have any strong opinions or thoughts about the concentration of risk in just the global equity market into so few players dedicated to a single theme?
The internet, where I'm going with this, changed the world. AI will continue to change the world. The wheel changed the world, the cotton gin changed the world, the printing press changed the world. At every point, each one of those things felt like AI. They were a complete step function to how the world worked. To us, this is different. This is new. This is nothing like anything that's ever happened before. And yes, it's nothing like anything's happened before. But it is a continuation down a never-ending growth and evolution of technology and innovation.
Mm-hmm.
And I think people have a hard time, coming to terms with that this time is not different Yes, it's new, it's different, it's big, and it's an acceleration. It's a constant acceleration. We're constantly accelerating, right? But in every one of those scenarios, right, history continued and things get overblown and underblown, right? Like, and then we go through much bigger cycles. So you got to step back and you got to look at all of it from a much bigger scope, from millennia, if you will, or however you want to think about it, right? And just understand that people get too out ahead of themselves every time when they see something that truly is transformational. But things get too overblown, too the speculation and assumptions of what that means in terms of profit and who will win based on those changes we're well down a path here that is clearly based on valuations, a sign of exuberance. Expectations are so high, we're extending some growth infinitely into the future, and I think that's irrational. So I think I will add to that as well that I'll take it even one step further. In a steady state, like this is overdone. But I would actually argue that the significant both growth we've seen in internet, AI, technology, this innovation, this broad innovation push that we've seen, which has been faster. It is a bit of an industrial, like a revolution relative to some other periods in history. It's a faster technological improvement, is largely a function of monetary policy. We took interest rates from 1982 to 2021 down 20 percentage points.
Yeah.
Because we went through a rebalancing cycle that created massive inflation because we had to rebalance from the rich to the poor and all of the excesses. And then we had a tool to just flush the system with liquidity, do supply side economics again and again and again for 40 years, anytime the market, slowed down. And that created the more monetary policy we did reflexively, created more structural deflation and more productivity growth and more globalization, right? But 40 years is a long time.
It freed up more low-cost capital to invest in corporate endeavors, right? Yeah.
I've made this point again and again, but I would argue Amazon, Uber, Tesla, you name your trillion-dollar stock, would not exist today if they weren't able to invest without making money for a decade or two. Amazon didn't make money for 20 years. What other time in history was a company allowed, right, to build for 20 years without making a dollar? Yeah, if you give me unlimited capital, I will build something great. I want to be clear. Give me unlimited capital. Do it. Give me trillions of dollars.
Right. For a prolonged period of time.
For 20 years. Yeah, I'll build Amazon. I'll build Tesla. I'm not, I'll find people smart enough to do the things. And the same is true for Tesla. Same is true for a lot of these other companies. It's not a steady state. It's not everything. Not all periods are equal. Not all situations are the same. Right. Money supply matters. And the technological boom we've had is a big function of that. So now, tell me what happens for the next 10, 15 years if we start to have to, because of a rebalancing time again, remove liquidity from the system. Everybody is projecting the growth that we've had for 20 years based on interest rates going from 20% to zero to the same technological growth that we're going to see now for the next 20 years. And I'm here to tell you that in general, that doesn't happen. And for structural reasons, that's not. The opposite is likely to happen. So right as everybody is all on the growth, technology, globalization train, like all the things that have worked for 40 years, the structural effects are going the other way. And I think pair that with just the exuberance that's out there already, and it's a dangerous place to be. That doesn't mean it's going to crash this year.
Yeah.
Right? I'm talking about the weighing machine and bigger picture things. But if you're not watching that, if you're playing the game of the last 40 years, I think you're in for a rude awakening.
All right. Super fascinating, sobering in many ways. But key thing to take away from that, as you just underscored, doesn't mean it's all going to fall apart tomorrow. All right. Well, look, Jim, I gotta wrap it up here because we're at the end of the hour. I could go another 2 or 3 with you. You're one of the most fascinating guys for me to talk to, and it's no surprise you're one of the folks that when it's been a while since you've been on the program, the emails, the drumbeat just starts. When's Jim coming back on? When's Jim coming back on? So thanks so much for coming here and scratching that itch for all of us. For folks that have really enjoyed this discussion and would like to follow you and your work, where should they go?
KaiVolatility.com, Kai Wealth, or up and coming Kai-Nexus. There'll be more about that to come. But any one of those, you can find some of the products that we offer investors and the advice that we can give investors based on our knowledge and background. So feel free to reach out. And again, always love coming on, Adam. You're one of the easiest to talk to, but B, you really dive deep. And I think that's why these conversations are always so great. So thanks for having me.
You're so kind. Sometimes I feel like I'm hanging on by my mental fingernails, but that's why I enjoy it so much. I learned so much talking to you, Jim. Okay, look, when I edit this, I will put up the URLs to those websites on the screen, Jim. But folks, if you want to get in touch with Jim directly, I'll have the links in the description below this video too, so you can just get there with one click. And folks, if you've really enjoyed having Jim on even half as much as I have, please let him know that by hitting the like button and then clicking on the red subscribe button below. And you should definitely go check out Jim's firm. Nobody, I think, understands volatility better. If you want some general help with your investing, feel free to reach out to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel every week. To do that, just go fill out the short form at thoughtfulmoney.com. Jim, really appreciate it. Last question for you, and it can be just a very short answer, but most people who are watching this are regular investors who prudently want to grow their wealth. They just don't want to essentially become collateral damage if some of these risks that you've warned about actually start to happen this year. They don't want to be caught by surprise by it all. What parting bits of advice would you have for them?
You don't need to bet long or short, right? You don't have to be 60% stocks, 40% bonds. What the whole financial wealth industry has told you, because it's worked for 40 years, right? 40 years, has an incredible momentum to it. If you didn't do that, you've pretty much been crowded out. But you don't have to bet long assets. That's not the only way to invest, right? There are non-correlated ways to invest. There are other ways to bet on the distribution of outcomes and still create really, really profitable strategies that can compound over time and in real terms. So that's something that we do at Kai Wealth, and there are others out there that do similar things. But that would be my parting advice.
All right. So you don't have to play checkers. You can play 3D chess. And folks, if you really want to learn more about that, definitely go check out Kai Wealth. Jim, such a pleasure as always. Thanks so much, my friend.
Absolutely. Thanks for having me.
Everybody else, thanks so much for watching.